I guess to kick things off, how do you see the current geopolitical environment impacting the markets and the metals markets and the investment industry today? So, looking at just some general impacts on supply, demand, pricing, etc. What are some of the big impacts that you're seeing right now?
I'm happy to start, Peter, if you want me to. So geopolitics is a great place to start, Amy, because I suppose that's right at the top of the tree, isn't it? And encompassing that, I think you've got to deal with conflict in the world. You've got to deal with deglobalisation, and you also have to deal with just the natural ebb and flow of supply and demand and those themes. But we saw in early 2022 the example of what conflict can have, the impact that it can have on markets, not just commodity markets. So Russia invades Ukraine, all of a sudden there's a disruption to certain commodity markets because the material would naturally have come out of that part of the world, and that's been either prevented or made more difficult. And then sanctions come into place, so it squeezes the market for things that Russia is particularly significant in supplying. And that kind of tension, this is a very high tension global environment coming back into almost a Cold War environment in a very modern sense. And that opportunity for disruption, I think, it always exists. We're moving almost into a higher expectation of conflict. So I think that's one part of geopolitics which is really important. But the deglobalisation, I suppose, of world markets is also important. Tony's just been talking about how China has a very small portion of the mining and out of the ground production of battery materials. It's got a far higher proportion of the refining, and then it's got an incredibly large proportion of the manufacture of batteries and the supply of that. So, if you just sit back and you say, well, if I'm someone sitting in in a country which is quite nervous about China, how do you either disrupt that or do you try and tilt the market away from those products? It's very difficult. China's sort of spotted that and wanting to be the new OPEC of battery manufacturer. So it brings a lot of things into the critical space which might not ordinarily have sat there purely on the basis of who's got their foot in the door for offtakes and refining and things. So I see those are the two critical themes. But Peter, you might have other ones, but I don't want to talk for too long. And
Thanks, Hedley. So just to give you some context, Orion provides development financing for mining projects around the world. I think the geopolitical thing, I'll take a bit of a different slant on it. Just by commodity selection, I think that gold is really showing the benefits of having it in a portfolio. It's an asset that changes its correlated drivers from time to time. Sometimes it tracks well with US rates, other times with geopolitical situations, other times with the US dollar. And its ability to provide a dampener in the portfolio I think continues to be highlighted in recent months. So from that perspective, I think gold's got a great place in anyone's portfolio. From a geopolitical point of view, rather than look at what's going on in the Ukraine and China, that's been well developed. I think developing countries are displaying unfortunate sort of signs of resource nationalism. I think if you look at the narrative that's going on in Latin America at the moment, it can range from Chile to Mexico to Ecuador. There's a lot of countries who want to tap into the value chain of critical materials without really understanding what's involved in that. That places a lot of equity at risk, frightens investors off. If we look in our own backyard, there's scarcity value in operating assets, and I think that underpins the value of a producing mine, independent of where it is. Permitting and licensing is just becoming more and more difficult in pretty much every jurisdiction globally. So scarcity value, don't discount it. So, yeah.
So you started to kind of talk about, gold being kind of a good metal to be holding on to. What other kind of commodities are you excited about or not excited about right now?
the biggest value driver for us is pretty much construction finance. And, you know, if you take the value of an asset pre-construction, you look at the value of an asset post-construction, in a 2 to 3 year period, you should be able to triple the value, the equity value of that project. So really, you know, in some respects, you should be agnostic as to whether it's gold, silver, PGMs, copper, lead, zinc. I mean, if someone can execute a business plan to drive 3 times equity value, then who really cares, you know, what the underlying commodity is? I think that's a bit of a takeaway. Having said that, we do focus on effectively industrial materials, which are orphaned, you know, by the capital markets and the banks. We do a lot of investing in the precious metal space and also in base metals. So I think that when you're providing construction finance, you really don't want to be underwriting high commodity prices to get your returns. I think if you're trying to achieve an investment outcome, planning on high commodity prices, that's not a really good investment strategy. So we underwrite consensus prices in our portfolios, which are generally way lower than, you know, spot pricing. So I think, you know, Tony made a really interesting point about the very small nature of a lot of these critical markets. I mean, that's got to be considered. You know, he mentioned cobalt, which has, you know, been suffering terribly. Another product which goes up and down as a byproduct is molybdenum, as an example, and, you know, it's a byproduct in some of the big copper mines around the world. Yeah, we try not to be selective in terms of, you know, picking a commodity just to underpin a higher price. Yeah.
I've got to agree with you, Peter. And when you're selecting an investment to make as an equity investor or even as a debt provider, you need to take a view that the commodity that you're in is going to work, but without being having sold the conviction call on that it's going to go to the moon. If it doesn't work on consensus pricing, you've really got to double check all of your assumptions there. I guess just taking a step to the side and saying, well, what am I excited in? Where do I see some really interesting fundamentals developing? We tend to look at things, and I think this is a similar way to you as well, Peter. You need to be able to extract and sell the product which you're taking out of the ground without taking a great degree of risk. There's some people who've been tremendously successful in doing that in products where they've literally had to educate the equity market about the commodity that they're selling and then have been successful. But, you know, you could count those on one hand compared to the people who've been successful extracting something from the ground which they didn't need to worry about the marketing too much. So I'm very much on the side of, if there's an established market, that's a great place to be in what you're extracting. Now, having said that, most conferences you go to at the moment, people are wanting to talk about the fundamentals for things like gold. We sit in an inflationary environment, and I think that contrast that to a huge degree of political, anti-will to have interest rates go too high. We're going to sit in an environment where interest rates, in a real sense, are sitting very low to negative, probably for quite some time. And with that playing out, it's the kind of environment where gold tends to perform. Now, I would offset that slightly in that go back 20 years or even 15, when we've had very strong markets for gold in the past. There's been a couple of drivers there which have also seen the gold producing industry de-hedging. So the gold producers have had to buy gold at the same time as they're trying to sell their product to the market in order to fix their balance sheets. That's not going to be a factor this time. So I see it being strongly supported, but would you see the multiples of return on gold that we saw from, say, 98 through to 2011? That could be a little bit of a stronger ask. But the other difference in a market like that is the nature of the investors who are taking part. Now, sorry, Emma, I'm going to call you out here. I brought one with me today, young, low 20s, this is an investor who, if you compare her with her peers, comes from a group which has a completely different ethical outlook on how to invest in anything in the world, right? Now, this is not Emma's particular proclivity, but a lot of people of that age are looking at things and saying, well, why do I want to invest in gold? What does that contribute to society? And if you discount financial stability, which I think is probably the big contribution that gold makes, do you need to take more out of the ground? So there's a legitimacy question there. I don't buy into it, but it's a legitimate thing that people are asking about. So I think gold's an interesting place to be, and it's the easiest thing you can extract from the ground and sell. We could go out with a shovel and a pan. If you could find it now, we could then sell it in the street outside. Literally, it's that easy to do. But add to that, I mean, copper. Everybody agrees, I think, that copper has a wonderful long-term fundamental. It's tied to just about every form of economic growth, whether it's decarbonisation, storage, or just normal economics. Great place to be, and an incredibly squeezed space. So long-term, I love that. Lithium has a big part in the next 10 years, I think, of battery manufacture. We're going to address a question at some stage in the near future about recycling of lithium batteries, and I don't think anyone has great answers on that at the moment. So for now, lithium is fantastic. I don't know where it will go, but I have a great deal of interest in it at the moment, and would be very keen to put some lithium in our portfolio from that sense. And I suppose I would add to that nickel, because it's another reasonable sized market, contributes to batteries, and has a real good demand story to it as well. There's a load of others, but they're probably my favourites.
Okay. You started to talk a little bit about kind of assessing risks and how that impacts your investment decision making. So what are some of the biggest risks and challenges that you're finding to the mining industry today?
The point in time when we invest is following the 15 years that Tony mentioned, which is how long it takes from first drill hole to being shovel ready, right? I mean, there's huge amounts of work that takes place up until that point in time. So we're looking at projects really from the point where they're shovel ready, and we're investing sort of across the capital stack. So we'll invest in equity, and we'll provide a good amount of leverage. I think the biggest risk, and this sort of touches on ESG, and it's not the E and it's not the S, but it's really the G, which is kind of talks about governance. And that's ensuring that companies are truly ready for construction and kind of looking at the work that they've undertaken in those 15 years, the quality of the engineering, the quality of the design, how they've run their procurement, how does a schedule fit together. Building a mining project, and now increasingly with critical materials, companies are aspiring to build midstream projects as well. They are some of the most complex projects you can come across in an engineering sense. So you're really analysing that risk and ensuring companies have got project controls and manage that construction process is the biggest value driver for equity, as I mentioned before, but it's also the biggest risk period. So it's really ensuring that the governance and the skill set, not only of the management, but really of the board, is appropriate to that opportunity. We spend enormous amounts of time focused on that.
To that very point, Peter, I think that's probably one of the biggest potential blockages between the money and the opportunity. You can have the deepest conviction in something as a project, but if it's not getting the G part of the E and the S and the G right, the money will just not follow. I mean, there's plenty of examples in the current market of large institutional investors withdrawing their money wholesale from a space or from a company in particular that has failed to meet their expectations of how the company would be governed. And sometimes that is as simple as the composition of the board. And it might not even be down to skills on the board, it's down to a mixture of other very basic things. Now, those are easy things to fix, one would think, but when there's a clashing of minds, particularly between company founders who can be quite belligerent in their own way, and institutional investors who can be equally belligerent in the opposite direction, that can pose an enormous blockage. So we invest in equity, and you can easily destroy the equity value and bring on tremendous dilution by finding yourself up against one of these blockages, particularly in a very rapidly shifting situation like that. If you went back 10 years, there was no discussion of ESG in company presentations. If you look through the video presentations, which I think are on YouTube, of a large industry conference like Diggers and Dealers from last year, it's like it's the year that Kalgoorlie discovered ESG. And it's not even so much the E, because I think a lot of participants in the mining industry are very, very conscious of what they need to do to meet requirements on environment. Social is something which most companies are also very conversant on and are in, by and large, I think, doing an excellent job. It's just that they've then had to promote it. And by the time you add the G, they're putting tick boxes right through this presentation to show what it is that they're doing great, which has nothing to do with how well they're extracting their product and selling it in many regards. So it's become an incredibly important part of how you present your story to the market, how it's digested, and then how capital markets follow it. But we've also seen in the last 10 years, I'll just add geopolitical risk. If you go back to the boom when China entered the market as a major commodity consumer, you could go anywhere in the world. I mean, for a while it was the 2 or 3 M's. Mozambique was a wonderful place to go and invest in coal. I mean, who the hell's going to do that now? Mozambique and coal. Mongolia was a tremendous place also to invest. It was really exciting from a geology point of view. There's untapped riches. There's been very, very few development stories that have actually come off of the tail of that. Oyu Tolgoi is one, but of course that hasn't been a lay-down misere in anyone's book. So geopolitical risk has crept in, and that's something which I think the capital markets have been acutely aware of. There's been far too many fingers that have been burnt from putting money into places where it's been extremely difficult to make a return, but not only that, to extract it from. So, you know, Canada, Australia, parts of North America have become the absolute go-to as far as where equity investors are prepared to put their money and provide a premium which might be double what they're prepared to pay for something in a what might be discussed as a shitty jurisdiction.
I was just going to say, to pick up on what Hedley's talking about, I'm not here to promote gold mining stocks by any means. We don't invest in them individually. But if you look at some of the gold mining projects in Australia, I think it's Capricorn Gold, Karlawinda, which is a really experienced management team, ex-Regis, and they've done an amazing job, and the investors love them. Their stock's going fantastically. Then there's a whole litany of other smaller or other gold mining stocks which are really suffering. And when you look at why they're suffering, well, they probably didn't do enough geological work or understand the geology properly. They didn't execute the construction of their plant properly, et cetera, et cetera. So I think it just comes down to, again, managing the risk and having a business model where you've got appropriate experience and skills. That's really what you're backing. Yeah.
Sounds good. Just to let our audience know, we are taking questions. So if at any point during, while our panelists are speaking, you have a question, just throw up your hand and we'll get a microphone over to you. So wanted to change a little bit. So there's talk about kind of, how do funds want to see companies spending their surplus cash? So is it kind of M&A, investing in further growth, dividends to shareholders?
I'm more than happy to.
Yeah, Hedley, go.
I'll start the baton, and then when I've done a lap, I'll give it to you, Peter. Look, I think that's a really broad question. Equity investors tend to be able to twist the hand of companies throughout the cycle. So in 2016, we saw investors just creeping back to mining, who I think had probably abandoned their investments in mining, or at least sold down to an extremely low weighting in their portfolios compared to what they'd held long-term historically. And that was off the back of a 5-year bust in mining. So as investors came creeping back, the things that they were concerned about was return on investment that is returned from capex spent within the sector. That had been the biggest crime which had been committed within mining up until the point of about 2011 and 12, was investing hordes of money in things which really just didn't add or return. And we saw the industry become very disciplined on cost, focused on OPEX, and the amount of capex which they are spending has declined dramatically as a result. Now, I think there's still a very sharp memory of this within the mining sector, within the mining sector's investment backers. So I think if someone was to approach some of their shareholders and say, I've got a great idea, I want to buy an undeveloped project. It might be in a non-ESG compliant commodity. It's going to be in a country that starts with M. You'd have an uproar, particularly if you were discussing spending $4.5 billion US on it in cash before you've got the certainty of being able to extract any of that stuff. There would be a great deal of pushback. Yet, we can see companies which are investing in growth, and we can see them engaging in M&A, which to me seems like it's driven by growth rather than necessarily adding to the bottom line or their profitability or their earnings per share. So I think we've seen a real evolution of that. The mining sector globally, and if you look just on ASX, the ASX 100 Resources Index is the highest yielding, lowest price to equity ratio sector on ASX, which tells you that investors are probably demanding to some extent that there's this yield. So dividends, I think, are a thing which is being demanded and happily accepted. And there's a reluctant return to growth. So where the big tickets are involved, it's dishing out shares rather than necessarily cash.
I think it's interesting to look at what are the motivations behind investors wanting dividends. If investors want an income stream and they want gold, well, then they should buy a royalty company. That's what a royalty company provides regular income. An equity investment exposes an investor through the value creation phase early on, and then will reward the investor for the good execution of the business plan by the company. Look, mining is a super capital intensive business. So if a mining company just pays dividends away as they have been really for the last 10 years, it basically results in them being growth constrained. So, there's a kind of balance to be had. If dividends are paid out in the normal course of business, I think they need to be very modest dividends, recognising the fact that companies need to continue to invest in their assets. And investors really want, the combination of explosive potential growth, and they want income streams. In some respects, that's a unicorn. That's just not possible.
Peter, I actually wonder, and I wonder if you agree, that, to some extent, there's almost an apology which is still going on from the large end of the industry, which is we've been irresponsible in the past. So I'm talking about the biggest companies here who, they've repaired their balance sheets. They've done so probably with the benefit of very cheap debt, as well as being the pinnacle of being able to raise equity in the market, but also having assets which, when you come into a low-cost, high commodity price environment, can just amazingly deliver their balance sheets very quickly. They're in a position to say, well, let's show how sorry we are by these enormous dividend streams. And by the way, that will separate us from our junior peers who we really don't want to see funded. We'd happy to be the funder of them, but we want it to be on our terms. So I wonder whether there's we're driving ourselves at the top end of the market towards being uber institutional and uber ESG compliant, and trying to, put the thin end of the wedge in to the smaller end of the market where they can really show a point of difference.
No, I think you're right. I was looking at some data yesterday showing the leverage of mining companies overall, and it's pretty much at the low point for the last 15 years. So there's an enormous capacity for the large mining companies to grow. In some respects, they're almost apologetic for being miners. They're like, oh, sorry, guys, we have to mine. We know we're ruining there's this sort of apologetic sort of nature behind what they do, which doesn't solve the supply issues that we're going to need as a result of all these government policies. So, yeah, we're in a bit of a funny place. But from a competitive disadvantage point of view, no, you're right. If you can remain large and dominant and low on the cost curve, then that's a pretty happy place to be.
I'd just add one sort of tiny stat to that, and that is, if you take the top 5 mining companies in the world by capitalisation, I can't remember what they're capitalised at. It's a huge amount of money, clearly, but they are capitalised collectively at about 13% of the combined capitalisation of the 5 largest tech companies. So you think about that, and you think about where institutional money will flow, and it might not necessarily be driven by returns by way of dividend. It could very well be returns by way of capital growth. tech stories, I think, have grown just across the market at something like a multiple of 11 or 12 times since the tail end of the GFC. So from 2009 onwards, there's been this enormous return. You don't see 10 times plus multiples across markets, except in very unusual circumstances. So, I mean, I'd read that as money abandoning mining to some extent, where you'd seen those kinds of returns in the previous boom, saying, well, return on investment there's cooked for a bit, let's put it somewhere else, and you've seen it go into tech. Now, across those top 5 companies, the top 5 miners paid around $31 billion of dividends between them in 2022. Those top 5 tech companies paid around $32 billion of dividends in 2022. So very, very similar sized dividend pool. I'd say almost the same. Yet the capitalisation of those tech companies is so much more enormous. So it's not necessarily even the returns which are driving this as well. There's a kind of a threat that, well, look, you guys still don't quite have your ship in order. We're quite happy to leave our money in tech. And I think the miners are probably cognizant of that at some level as well. So by wanting to be big and relevant and maintaining that spot right at the top of the tree is something that they're quite concerned about, to make sure that they tick all the boxes. There's no excuse not to hold them, that when there's another re-rating and reshuffling of that money, that the BHPs and the Rios find themselves being extremely significant in terms of companies in the world, not just within mining.
We have a question at the back. Can we get a microphone over?
Yeah, just that last point. So that very interesting in terms of dividends, flows, and so on. But do you tie that back to your first point? Is that those big companies are seen as ex-growth, whereas the tech companies are still seen as on a trajectory of substantial capital growth. So that's why the money's flowing to those guys vis-a-vis the mining companies who, as you say, are sort of, really not putting money into the growth piece of the equation.
Yeah, I think that's a great big part of it. I mean, how do you grow a tech company? I think you start in a Harvard dormitory, you possibly involve some illicit substances, and you have a great idea, which grows through some genius, and that's the capex. So very low capex involved in tech as well. Tech's been around for a while, and tech has always been let's call it a low capex growth story, and it's had its episodes. I mean, we've had .com bubbles and busts, which were quite destructive, and off the back of that, we then had one of the largest mining booms in terms of returns ever to take place. So I sometimes sit back and wonder, and you have to make this a cartoon because you can never completely quantify it, but money sloshing from one big pool of investment to another, and it's definitely driven by that, what's the capital going to do and where's the capital required, and it's then that perception of growth. And sometimes the perception of growth can be aided very much by your track record. We're at an interesting juncture now, though, because those big tech companies are sitting off the back of a decline of about 30% in their capitalisation as well. So they're certainly not sitting at their pinnacle. They've come back a fair way from where they got to in late 2021.
Do we have any other questions from the audience? All right, so we are getting close to the end of the session. One of the major themes in the industry today is the energy transition. And so to close off, I wanted to kind of ask, how do you see investors' roles kind of developing in terms of your role in the energy transition? What does it mean?
There's a flood of capital but it's not in the right form, unfortunately. So government policies, as we can all observe, newspapers and the media, and we could, there's a government policy every day, and there's money being allocated every day. A lot of the, I think you've got to look at the businesses that are going to help the energy transition need to be profitable businesses. They're very complex, and they're going to play a role for decades. And so they need to be profitable businesses, executable business plans, and therefore they need to attract equity capital. There's only so much you can achieve with debt. It doesn't matter whether the debt's low-cost government debt or high-cost debt from from another source. Equity will get attracted to good business models. Well, Hedley will tell us what attracts it, but good business models, executable business models, and where there's pricing, there's some form of pricing certainty, etc. So I think that is really the missing piece. It's where is the equity to support that?
Well, the new world economy, if you like, which involves decarbonisation and storage and all the rest of it, of power and electricity, is an enormous pull. So there's this huge nebulous concept of we should invest in this. We have a huge hurdle, could be considered a blockage for a lot of institutional money, which is that it needs to tick a lot of ESG boxes. That makes things more difficult, and it means that things have got to be done cleanly. I mean, in a lot of cases, these are very good things which they're demanding. It's just do it right, because we're not talking about people that sit in a dark room and don't harm anybody else outside of that room by generating their tech. We're talking about people who dig holes, install tailings facilities, etc., and that needs to be done in a responsible fashion. So I'm not bemoaning ESG, but it does sit there as an enormous compliance burden, and it makes it harder for institutions to get involved in a big way. And that has been money which has driven investment in previous cycles until now. You've got retail investors who are, determining their way of the future, and the ethical pull of investing in these new forms, I think, is extremely strong, particularly for younger generations. They see that as something which is very, very relevant. And you've also got these new pools of capital, particularly where you've got governments involved that want to see industries developed in their countries and to guarantee compliance, surety of supply, all of those things. The example which Tony gave was that, to get some of those grants which are available, it's a very, very long-term process. And I mean, it's almost as analogous as my kids all play cricket at our local cricket club. There's a push to put a roof over the nets. We've just had a couple of very wet off seasons, and they'd love to be able to practice through September and October when it's typically been raining. I mean, it's what you get when you live in Melbourne, right? Just don't play cricket. It's one of those sports. To put a roof over the nets, we've had a guy who's a project manager. He's very good at pricing things, and he's pulled together all the quotes he needs to understand how much it's going to be. I'm not going to tell you what the price is, but to put essentially a shed without walls, around these nets is one price. And then you go to the council and say, well, this is your facility. You need to be involved in this. They say, well, yeah, great idea. Everyone will love this. That's a very electable thing. Let's put a roof over it, but we need to get our guys involved, and we need to have our ticked off suppliers. And by the time you do that, you don't end up with a 1.1x or a 1.5x on the original cost. It's a 2.3x difference in cost. So, if it was 100, it's now 230, or if it was $500,000, it's anyway, you do the numbers. But when governments get involved, and this is a local council, right? So this isn't the highest level of government, this is the lowest level of government in Australia. The price goes up astronomically. There's a huge amount of compliance. And when you talk to the suppliers, they're like, well, to do that, I need to employ 3 extra people to tick all the boxes that the council requires. And, read between the lines, they've also got to pay them a hell of a lot of money. So for a council supplier to put this roof over the thing, they need to stop traffic on a road that doesn't get traffic between Monday and Friday, except when kids are training. But they need a lollipop person there all the time. So there's just all these add-on things. So when the government money gets involved, there's a huge amount of it for building these big projects, but it takes a very long time, and it can be expensive money when you look at all the things that you've got to add on to it, which drives inflation in the market. So it's an interesting driver, but there's a lot of complexity behind it, and I don't think it's necessarily a flatter capital going to it either. It's a lot of interest and then a lot of hurdles to jump.
I'll just conclude with one thing. There's vast amounts of savings pools all over the world, pension funds and so on. A lot of them have got infrastructure allocations. And if you look at the returns that are available right now in infrastructure, they're pretty low. I mean, you're talking about single-digit equity returns for renewable projects. We're in the same value chain. And so the challenge for us is to explain to these people, you don't have to put your ideology aside. Examine the value chain. Go further upstream. You can make a huge contribution. You can make some great investment returns. Certainly, a multiple of your single digits you'll get out of a contracted solar farm. So there's a lot of work to be done. But I think that the big people managing huge amounts of money, they need to broaden their thinking. Yeah.
So to close off, do we have any questions from the audience before we let our panelists go? All right. Well, thank you to Hedley and Peter for joining me up here today.